Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about IREN. So IREN Limited is in the middle of this really dramatic strategic pivot. They're moving away from being a pure play Bitcoin miner to trying to establish itself as a major high-performance computing and AI cloud provider. And this is not just a rebrand. We're talking about a massive infrastructure transformation. And the market reaction has been just explosive.
Explosive is definitely the right word. I mean, we've seen truly violent price swings around these major corporate finance events in early December. You have to consider the immediate 15% drop on December 2nd. That was right after they announced the $2 billion convertible note offering and the $1.63 billion equity raise.
Right.
And then, almost immediately, the stock just completely reverses course. It's driven by analyst coverage, details on the capital deployment. You see a 6.91% rebound the very next day, and then a staggering 14.74% surge a week later.
And this extreme volatility, it's really the symptom of a profound tension in the stock. We're also tracking exceptionally high trading volumes, particularly in these off-exchange venues, what we call dark pools, which are, consistently processing 30, even 40% of the daily trade volume.
And that volume and the chaos that comes with it, that's exactly what we need to analyze.
Exactly. The fundamental question for anyone looking at this is IREN's current stock price and this wild volatility, is it primarily driven by the massive secured fundamental value, that AI pipeline they've locked down, or is this price action just a distorted reflection of these complex temporary market mechanics? The arbitrage, the shock of dilution, that's maybe obscuring the real long-term value. My position is that these structural dynamics we're seeing aren't, for the most part, temporary market noise. They're distracting the street from what is overwhelming, secured long-term value.
And I'm going to argue that the sheer, just unprecedented scale of this capital raise and the structural volatility that comes with that financing mechanism remain the dominant forces dictating the price action and, frankly, suppressing the share price right now.
Okay, so to start, I think we have to maintain a laser focus on the secured revenue and this strategic moat that IREN has built. The evidence for fundamental strength it's almost unassailable. I mean, they have a binding $9.7 billion 5-year cloud services contract with Microsoft. That contract alone validates the entire strategic shift.
That dollar amount is impressive, I'll grant you, but big numbers are often subject to big risks.
They are, but this feels different. This $9.7 billion backlog is being funded by a massive $5.8 billion hardware acquisition. We're talking cutting-edge NVIDIA GB300 GPUs from Dell. So this isn't some theoretical future revenue. This is secured capacity against a contractual backlog with a tier 1 hyperscaler. And look, I see why the immediate capital raise is concerning, but we need to reframe it. The $3.63 billion they raised in both equity and debt, it shouldn't be viewed as just covering a burn rate. It's a mandatory war chest needed to fund these incredibly high-margin income-generating assets.
I agree that the market may eventually re-rate this, but the immediate pain for shareholders is undeniable.
The market is already reassessing. I mean, that's why we saw that surge after the analyst updates, including a street high target of, $136. But here is the real differentiator, the true moat. IN controls approximately 3 gigawatts of secured power capacity. Power is the scarcest, most critical commodity in the entire AI supply chain. This gives them a critical time-to-market advantage that hyperscalers like Microsoft are willing to pay a massive premium for. And that's evidenced by that crucial 20% contract prepayment. That prepayment is basically Microsoft saying, we need your power capacity now, and we will pay you upfront to guarantee it.
That is a compelling argument about the ultimate opportunity in their strategic position with power. I get that. But we have to ground this discussion in the mechanics that actually cause the price volatility, not just where it might end up. I come at this from a fundamentally different direction. That 15% price drop on December 2nd wasn't driven primarily by a collective freakout about the long-term plan. It was a textbook mechanical repricing event triggered by that $2 billion convertible note.
That seems a little reductive, focusing only on the technicality.
It's not reductive, it's just financial reality. So when hedge funds buy those $2 billion in convertible notes, they use a strategy called delta hedging. Now, this is complex jargon, but let's just break it down simply. They want to profit from the spread between the note's interest rate and the equity while neutralizing any directional risk. To do that, they simultaneously short sell the underlying equity. They borrow shares, and they just dump them onto the market immediately. This structural selling added a huge amount of supply to the order book. So that drop was a function of structural selling pressure, and it's almost entirely unrelated to the fundamental value of the firm or that Microsoft contract.
I follow the mechanism, but those shorts are temporary in nature.
They are temporary, but they are significant. And what's more, the concurrent $1.63 billion equity raise represented a substantial direct dilution relative to the market cap at the time. When a company expands its share count by that much, the price per share has to mathematically adjust downward to maintain the same enterprise valuation. And you have to compound this with the environment. The stock is tied to two incredibly volatile sectors, AI infrastructure and the broader crypto market. This creates this dual risk exposure where any significant risk-off sentiment in either sector just causes an amplified sell-off, and that prevents any sustained upward momentum. And speaking of structural forces, let's go from the financing to the trading. You mentioned institutional accumulation, but I remain highly skeptical that the microstructure here is harmless. I'd point to the exceptionally high off-exchange short volume. Sometimes it was exceeding 40% of total volume, like we saw on December 3rd. Now, while some of this is required for the convertible hedging, this immense opaque selling pressure fundamentally suppresses the publicly quoted or lit price. It benefits large institutions who can do massive block trades and negotiated prices, and it blurs true public price discovery. It's a constant technical headwind.
See, I'm not convinced by that because you're conflating two very different activities under this umbrella of dark pulse suppression. That high volume is actually a function of two distinct and crucially non-nefarious mechanisms: institutional accumulation and retail internalization.
Okay, explain institutional accumulation in this context.
Sure. When very large funds, mutual funds, pension funds, are building massive long positions, especially after new positive analyst coverage like that $136 target, they can't just execute a single massive order on the public exchange. It would instantly spike the price against themselves. So they use dark pools to accumulate shares quietly, often over days or weeks, without alerting high-frequency traders who would front-run them. This dark pool volume is actually, I'd argue, indicative of fundamental strength building up over time. And secondly, a large portion of that volume is simply the internalization of retail orders executed commission-free. The wholesalers just fulfill the orders without sending them to the public exchange. So I'm not convinced that the short interest is evidence of this pervasive suppression dictating the price. The total short interest is high, about 24% of the float, but the underlying mechanics are surprisingly benign. The cost to borrow IREN shares is very low, usually under 1% annualized.
But what about the risk of a short squeeze? With that much short interest?
Well, that's the key metric, isn't it? The days to cover ratios are around 1.5 days. What this means in plain English is it would only take the shorts about a day and a half to buy back every single share they borrowed, assuming average daily volume. So this low metric indicates the stock is highly liquid. The short positions are largely structural hedging. They're cheap to maintain. And that really limits any true squeeze potential unless liquidity just suddenly evaporates. It's a temporary friction in the market plumbing, not structural decay. Let me pivot back to valuation, which is, at the end of the day, the ultimate driver. I want to address the core valuation disconnect that I think a lot of retail investors see. This argument that the market is currently mispricing the Microsoft deal and applying a minor multiple, maybe 5 to 10 times EBITDA, instead of the appropriate AI infrastructure multiple of 20 to 30 times.
I mean, that gap is enormous.
It is. And when you calculate the $9.7 billion backlog relative to the depressed share count, it becomes, geometrically clear that the current price is severely depressed solely by this dilution discount and the mechanical selling we just discussed. The fundamentals are just screaming that the value is far, far ahead of the current trading range.
I'm sorry, I just don't buy that the discount is solely due to mechanical noise. That's a compelling argument for the potential revenue, I get it. But have you rigorously considered the execution risk inherent in this pivot? You present the $9.7 billion as a certainty, but that certainty hinges on them successfully executing a monumental transformation.
Well, they've secured the hardware and the power. What specifically is your chief concern regarding the execution?
The complexity. They are moving from simple air-cooled ASIC mining, which is, let's be honest, essentially a plug-and-play energy arbitrage operation, to operating massive, complex, liquid-cooled, next-generation GB300 infrastructure. These aren't standard data center chips. They are super chips, requiring completely different infrastructure, complex fluid dynamics, entirely new network architectures. This is an incredibly complex undertaking. It requires a whole different level of operational sophistication.
That's fair. This isn't easy.
It is absolutely non-trivial, and the risk is profound. Any failure in those sophisticated liquid cooling systems, any network glitches, or prolonged power stability issues, all of that could lead to service-level agreement, SLA breaches with Microsoft. If they fail to deliver the contracted uptime or compute efficiency, they jeopardize that entire $9.7 billion revenue stream. The stock is currently pricing in this very high execution risk and, frankly, the financing risk. You called the $3.63 billion a war chest, but it comes with a cost. What's the actual interest rate burden of that $2 billion convertible note? And how does that affect the overall enterprise value in the short term?
The immediate financing risk is hedged by the fact that the capital is being deployed immediately into income-generating assets, so the debt service is manageable, especially given the high margins they expect on the cloud services contract. The capital raise, while painful short-term, ensures they can meet the hardware deployment schedule without cash constraints. So it mitigates the financing risk even if the interest cost is a factor. They prioritize speed and scale, which is essential to winning the AI race.
And prioritizing speed over structural cleanliness is what leads to these periods of volatility. One final structural element that just continues to confuse and weigh on retail sentiment is this fear about the capital structure, specifically the widespread, yet entirely incorrect fear of reverse stock splits.
That's a really important point because misinformation can create real, sustained selling pressure based purely on fear, and we have to provide a definitive rebuttal based on the source material. IREN Limited has never conducted a reverse stock split since its 2021 IPO.
So where does that persistent rumor even come from?
The confusion stems almost entirely from a ticker collision with an Italian utility company, IREN SPA, which trades under a similar ticker globally. The absence of a reverse split is a fundamental quality signal. I mean, think about the height of the crypto winter. A lot of miners saw their share prices fall below that $1 threshold, forcing these cosmetic reverse splits just to avoid delisting. IREN's ability to maintain a share price generally well above that confirms superior capital management compared to its peers.
So the dilution we saw was painful, but it was strategic, whereas a reverse split would have been a sign of underlying weakness.
Precisely. The dilution, while mathematically painful, is strategic. It's an exchange of equity for cash to fund assets that will produce income. A reverse split is purely cosmetic, often a desperate move to just shore up the listing status. That distinction confirms fundamental stability.
Okay, so to summarize WAP perspective, while the binding $9.7 billion contract is undeniably attractive and provides massive validation, the current short to medium-term market structure is still dictated by overwhelming mechanical forces. We have persistent mandated selling pressure from the convertible arbitrage, the mathematical reality of significant equity dilution that has to be priced in, and this latent risk premium associated with successfully executing the complex GB300 deployment. These structural dynamics are the noise that prevents the market from accurately pricing the fundamentals.
And my summary is that the fundamental strength, the secured, contractually obligated $9.7 billion in Microsoft revenue, and that strategic 3-gigawatt power moat, it overwhelms and will eventually overcome this temporary market noise. IREN is no longer a leveraged derivative on the Bitcoin price. It's a highly leveraged bet on two of the world's most critical resources, secure power and next-gen AI infrastructure. The high drug pull volume, the short interest, that's just the transactional tax you pay when a company undergoes a transformation this rapid and moves this much capital so quickly. The current price depression is a function of market plumbing friction, not fundamental brokenness.
We both agree, I think, that the consensus price target gap spanning wildly from a low of, $39 to that aggressive street high of $136, that gap perfectly reflects the market's current struggle to reconcile these two competing forces. The immediate structural volatility against the enormous long-term fundamental growth opportunity.
Absolutely. The key risk remains execution, but the key opportunity remains the monetization of that secured 3 gigawatt power capacity. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.